The second housing crash has begun. Some markets are well into it, while others have only just begun. The US housing market has gone down, and in some big cities, it has gone down very sharply. Other markets aren't as far ahead. During the first housing crash, some cities like Miami, Phoenix, San Diego, Las Vegas, etc., were ahead of others like San Francisco. People in San Francisco thought they wouldn't be affected by the housing crash that was happening all over the country in 2007. Then it came back with a vengeance to San Francisco. This time, Boise, Seattle, San Francisco, Silicon Valley, and a few other cities are in the lead. In the San Francisco Bay Area, the median house price fell faster in the first 10 months of housing crash number 2 than it did in the first 10 months of housing crash number 1. Since mortgage rates started going up a year ago, home sales in the US have dropped every month. In January, 37% less homes were sold in the US than in January of last year. Sales dropped everywhere, but they dropped the most in the West by 42% from the previous year and the least in the Midwest by 33%. This is going on everywhere. In January, the median price of all types of homes in the US fell for the 7th month in a row. Since the peak in June, prices have gone down by more than 13%. Some of the drop is due to the time of year, and some is not. This drop cut into the year-over-year gain, which is now only 1.3%. At this rate, prices will go down from one year to the next in February or March. This will be the first year-over-year price drop in the US since the housing crash of 2008. Active listings went up by almost 70% from a year ago, but they are still low compared to the past. A lot of people are sitting on their empty homes and not selling them. Instead, they are renting them out or trying to make money as vacation rentals. Late last year, the average 30-year fixed mortgage rate went over 7%. In January, it dropped and went as low as 6%, which made everyone in the industry happy. This was done because people were really hoping that inflation would just go away and that the Federal Reserve would soon cut interest rates. But by the beginning of February, it was clear that inflation wasn't going away. The inflation data showed that inflation is picking up again and that this process began in December. Some prices for goods are going down, but inflation in services is at its highest level in 4 decades. Almost 2/3 of what people spend their money on is services, and it's hard to get rid of inflation from services. The Federal Reserve will have a lot to do to deal with this, which means rates will stay high for longer. So, how many homes aren't being lived in? The Census Bureau keeps an eye on this. During the fourth quarter of last year, there were almost 15 million empty homes, condos, and rental apartments. That's more than 10% of all homes. In 2022, there were over 1.3 million more homes than there were in 2021. If each housing unit is home to an average of 2.5 people, that means that 3.3 million more people will have a place to live than the year before. In 2002, the US population hasn't grown anywhere near that fast. Okay, so now there are almost 15 million homes that are empty. 11 million of them were empty all year. Some of the 11 million were being fixed up to be rented out, while others were for sale. So this is the inventory we actually see, and there are other reasons why homes were empty. But 6.6 million homes were kept off the market for a variety of reasons, such as the owners not wanting to sell at that moment. If just 10% of the 6.6 million homes that aren't on the market come on, the number of active listings will double. If 20% of these homes went on the market, there will be a huge surplus of homes. During the free money period of the pandemic, prices went up so quickly that this huge drop didn't even get them back to January 2020. During these 3 years, not that many people bought a house, and even fewer bought near the peak. So the drop in prices didn't really affect a lot of homeowners. It only affected people who bought their homes after mid-2020. That is not a very big number. The vast majority of homeowners who bought their homes in 2019 or before are still above water, and many of them still have a lot of equity. Median prices are not the most accurate way to look at things. They change a lot and happen at certain times of the year, and a change in the mix can throw them off. For example, if the rich take their homes off the market because they can't afford to keep them, and only homes in the middle to lower prices ranges sell. There are fewer high end homes in the mix of sales, which makes the median price go down. This happened during housing crash 1 and was a factor in the 58% plunge in the median price. There are other places like Boise and Seattle where home prices are falling like they are in the Bay Area, but other markets have just begun to go down. In the Bay Area, home sales, so the number of sales that closed, collapsed by 37% year over year, which is just above the national average of 34%. This is a sign that the market is frozen. In the Bay Area, the number of active listings has gone up and the number of days on the market has almost tripled from a year ago to 32 days. It is now common to take the house off the market. A lot of people who want to sell their homes now put them on the market at prices that are too high and no one shows up. A month later, they stop selling it. After a month, they put it up for rent to see if they can get enough money from rent to cover the mortgage payment. And it's clear that doesn't work. So they take it off the rental market a month later, then after another month, they put it back on the market at a lower price. Others are trying to make that money as vacation rentals, but there's a lot of competition in that area. If the price drops enough, the home will sell in the end. Anything will sell if the price is right. The reality is the clearing price. The hardest part is for the seller to agree to the clearing price, if they can afford to sell at the clearing price at all. Some people put their home on the market at the right price right away and they sell quickly. This is not the time for sellers to take their time. If they wait too long, prices will go down. It's not like there are no buyers or markets out there. There's a market and there are people who want to buy things, but both are a lot smaller than they used to be. So why does everything happen so quickly? It's not about money. People are working and their pay has gone up more than it has in the last 40 years. Still, unemployment is close to all-time lows. People are getting fired and getting laid off at rates that are close to all-time lows. Even when the economy is doing well, there are an average of 1.8 million layoffs and discharges every month. Every month for the past 2 years, including late last year when all the layoffs were announced, the total actual layoffs and discharges were below the good times lows before the pandemic. They were 1.5 million a month or less, which is the lowest number in over 20 years of data. When more of these layoffs happen, unemployment goes up because companies stop hiring people who were fired or laid off suddenly can't get a job. So far, that hasn't happened. Companies have been making a big deal about these layoffs for months. Most of the time when they do, their stock price go up. But these are just announcements, not actual layoffs. They are made by global companies for their global staff, and many of these layoffs happen in other countries. Companies with more than 75 workers have to report layoffs. This makes it easy to find out if someone was actually really let go. In terms of the number of people who lost their jobs, San Francisco was the worst, but it has only laid off 7,000 people since July, despite all the noise about the 5,000 people who lost their jobs at Twitter alone and the tens of thousands who lost their jobs at a number of San Francisco-based companies with big offices in the city. And that was the worst that could happen in California. But other companies are hiring, and the total number of jobs in California has still gone up. In other words, there isn't a sudden increase in joblessness. The market for jobs is still tight. People have jobs and are getting big pay raises. Many people who lost their jobs quickly find new ones. The housing market should benefit from this. But a rise in unemployment didn't slow down this housing market, not even in the Bay Area. The housing market could be hurt due to unemployment in the future. So far, what has messed up the housing market is a toxic mix of several things, such as mortgage rates going up. The prices of homes had gone through the roof, and the sharp drop in stock prices and the fall in the prices of cryptocurrencies have taken away the excitement as many people lost a lot of money. The Federal Reserve's monetary policies were the only reason why home prices went through the roof. Between March 2020 and March 2022, it printed nearly $5 trillion in new money to keep long-term interest rates, like mortgage rates, low and to create the biggest asset price bubble ever. But all of that is over now. We have a lot of inflation now, and the Fed has raised rates and plans to raise them even more. Rates will go over 5%, and the Fed is working on something called quantitative tightening. By the end of February, it had cut its balance sheet by over $600 billion. So the Fed is raising rates and reducing its balance sheets, and the prices of stocks, bonds, cryptocurrencies, and housings have all gone down. We're seeing the biggest asset bubble burst ever, and home prices are a big part of that. There are lots of jobs, wages are going up, people are spending, businesses are spending and investing, and the government is spending like there's no tomorrow. This could change. Unemployment could go up and job openings could disappear. People who lost their jobs could cut back on spending, and state and local governments that are still swimming in pandemic money will run out of this money and then have to cut spending. All of this is another thing that could happen to the housing market. But the prices of homes haven't gone down yet. So far, the fall in the housing market has been caused only by the sudden end of the free money everyone had been used to getting since 2008. The second housing crash could be a wake up call from the decade of easy money and the return to reality. If you watch the entire video, keep the streak going and watch the next wealth building video. Don't forget to like and subscribe.